Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to lesson, we're going to have a continuation of last week's theme, reasons why multifamily investors fail. This is part 2. Go back to last week and listen to part 1. I love to recap it, but I don't want to spend too much time on last week's because last week I took a deep dive into 5 things that I saw multifamily investors make, their mistakes that they made. And you may be saying to yourself, well, how do you know that, Gino? I've been coaching multifamily for over a decade. I've been investing for over 20 years. I've either made all of these mistakes proudly and not so proudly, and I've witnessed our community make these mistakes. That's the reality. Smart people learn from their mistakes. I'm a really smart person. Wise people learn from others' mistakes. That's why I'm sharing this with the entire community of multifamily investors. I want you to be wise. I want you to learn from the mistakes that I've made. It's just going to make for a much stronger multifamily market. If over the last 3 or 4 years, all these newer investors were bidding up all these assets, prices would have been a little bit better. There would have been more people buying these assets at better pricing. Instead, now we've created just a disaster in the market. There's a lot of deals that are going to be lost, a lot of LP equity that's going to be wiped out. This happened in the previous market cycle. And all these mistakes that I'm about to share with you all happened in the last market cycle. They're all happening in this part of the market cycle, and they're going to continue to happen in future market cycles. Now, this very first one that I'm going to share with you today, this is exactly what happened with Jake and myself. It wasn't so much of a problem. It's just that once we closed the deal, we weren't sure what to do. And that's lack of a strong team. Now, don't let this hold you back, because I see a lot of investors saying, I need to have everybody. I need to have, well, really, the only people that you need when you're starting your journey in multifamily and investing, you need a really good real estate broker. Those are the ones that are going to give you great deals. Then you need a sort of an attorney to close the deal for you. They're not really that hard to find if you're doing a regular multifamily deal. You need those 2 people. If you have those 2 people, then it comes down to finding a property management company. If you're not managing yourself, Jake and I manage ourselves, but really vetting a ton of property management companies. Then obviously you want to have some type of contractors. And then I think one person that I think is often overlooked, I should say, is an inspector. We were fortunate on that very first deal to have a good real estate broker. They actually helped us through the deal, even though they sort of weren't representing us, but they were. It was confusing. The seller was such a mom and pop. They wanted so much out of this deal that our broker helped us even to secure seller financing on the deal and helped us with the finance part. So we actually had a bank in play from the seller because we were using the seller's bank. So you're seeing we had some parts of a strong team that were coming together, but we weren't able to we didn't have a great contractor when we first started, but we did find a great inspector who actually inspected the property, saw some things that were wrong, and we actually got discounts on the property. So one of those, as you're building your portfolio, you need to focus on a strong team. Real estate broker, attorney, cost segregation specialist. We didn't have one when we started. You don't need one when you start, but you're going to need one, right? Don't let that stop you. And property management companies. I would say those are some of the tops that you need. Not having that strong team will hinder you. And now, how do I know that? I've seen it from my own personal experience of life before Jake. I didn't have a strong team. I didn't have a strong attorney. If I had a great attorney, they probably would have told me not to do one of my most disastrous deals. It was just not a good thing. I didn't have a great inspector. There were so many things wrong with the property that I didn't pick up that he should have picked up, and I could have retraded on those. So number 1 is lack of a strong team. Number 2, this is going to really bite a lot of people in a sort of a bad way. And this is multifamily. It's really a long game. You can play the short game, but it's like musical chairs. At some part in the market cycle, if you're not playing the long game, if you're not securing debt for longer, if you're not trying to mitigate your risks with that finance right, you're going to be the one without that chair. And that's what's happening right now. A lot of these investors got in 2015, 2016, 2017, where deals, typical life cycle is 5 years. Well, they were flipping out deals within 3 years. And then all of a sudden it became 18 months. And then all of a sudden it stopped. You have to be very careful. You can play the short game and flip these assets when it's the right part of the market cycle, understanding that's important. But if you're only playing the short game, it's to me, why even be in multifamily? You're basically a glorified fixer and flipper. If all you're doing is buying these multifamilies, generating revenue, and flipping out, looking for the next deal. We've owned deals for over a decade. And I can tell you, buying a deal at $45,000 a unit, holding on to it, refinancing that equity out, and still owning it today, and it's worth over $170,000 a unit. You do that for a couple of deals, you'll become extremely wealthy. You won't be on the hamster wheel of having to do transactions. You're operating the deal, but it's a long-term vision. Just be careful. Now, if you want more information on how to find a community that teaches multifamily, just go to wheelbarrowprofits.com and schedule a call with one of the guys on the team there. For me, if you're going to get into any kind of real estate investing niche, if multifamily is your gig and you're really considering it, just go to the website, schedule a call with the team, see how the team can help you out. And that's one of the biggest mistakes that I made also. It's not part of my top 5 here, but when I started, I had no mentorship. 2 places you learn. You either learn on the street or you learn in the classroom. I unfortunately learned on the street. I lost my $172,000 on my first deal. That was a very painful mistake. You're talking 20 years ago. That was a lot of money back then. It's a lot of money now, but it was a lot of money back then. I quickly learned that I didn't know what I was doing, and I actually went and joined 2 mentorship groups. And when I did that, what was great about it was Jake Stenziano, my business partner, just sort of fell into my lap, and I was prepared. So if you're really seriously considering investing, either as a limited partner and just doing it passively, or as an active investor, you need to learn the business. You need to learn how to buy right, manage right, finance right. Now, this third one is all about the buy right criteria. Jake and I were at a syndicators event. This is probably about 3 years ago, in the height of all of these syndicators raising tons and tons of capital. And we're on stage and we asked the question, how many of you out there have a buy right criteria? It was crickets. It was like deer in the headlights. I was shocked. I don't even think they knew what that meant. If you don't have a criteria to buy a deal, then what kind of deals are you looking for? If you don't have clarity, you have confusion, you have motivation, you have that lack of motivation, it's going to be a lot harder to raise capital and you're more prone to making mistakes. Now, what do I mean by a buy right criteria? It's important to understand that every single market has different criterias on the type of assets that you're looking for and the type of assets that you can buy. If you are and I was in Rochester, New York, and I'm not hating Rochester, New York, but if you're in the city of Rochester and you're looking for new assets that are going to cash flow with a certain amount of median income, you may not even find those assets. So the first thing is, after you check your market, you pick your market, well, what criteria, what type of assets are you buying? Now, coming into this decision, which I think is truly important, is you as an investor. If you're a younger investor, your criteria may be to go after assets that may have less cash flow, but more appreciation, because cash flow gets you out of your job. Equity or appreciation keeps you out of your job. So if you're younger and you don't need to live off of your real estate right now and you can continue to reinvest, maybe you're looking into those markets that have lower cap rates, have more capital appreciation. If you're an older investor and you're looking to what we call coupon clip, maybe you go into those markets that have a blend or maybe a little bit more cash flow intensive. That's what you need to understand first with the buy right criteria. Second, you pick the market, and then what is your criteria? When I started, I had no criteria. I was just looking for a deal. And that's what most new investors, they make that mistake of, they're looking for a deal. Well, what's a deal to you? I'm looking for the best return. Well, what does that even mean? I fell into that trap. I had money, guy had experience. I gave the guy with experience my money. The guy with the experience kept my money, and I unfortunately got the experience. I don't want that to happen to you. So Your buy right criteria needs to be specific to the market you're in, needs to be specific to what your investment goals are, and it needs to be really detailing out the type of asset that you want to buy. Right now, it appears in mid 2025, everyone is having what we call a flight to quality. If you are in the stock market, this would resemble something as in going into the S&P 500 or the Dow Jones 30. You want assets, stocks that have more stability, that are giving a little bit more of a yield. There may be less upside, but your downside risk is really, I don't want to say protected, but there's less risk on the downside when you're going through this flight to quality. There's less value investing or risky investing or small capitalization, small cap stocks investing. In this part of the market cycle, that's what's going on in real estate. That's why having a buy right criteria is important. I'm not saying not to buy older assets in this part of the market cycle, but you can't buy them at 4 and 5 caps like you did 2 years ago. You need to buy them with what we call positive leverage. If interest rates are 7% right now and you're buying a 60s, 1960s C cap, C property at a 4 or 5 cap, and like I said, rates are 7, that's negative leverage. You need to get that 4 or 5 cap up to at least a 9 or 10 post renovation to make that deal make sense. There's a lot of risk in that. So understanding the buy right criteria, what we're looking for right now in our part of the market cycle in Tennessee, newer assets, 1980s at least and newer. We're looking for what we like, median income of at least $50,000 in our market, right? We're looking for certain parts of the city. In our city, we're not looking in the east side. We just don't like the median income, a lot older buildings. We love townhomes, 2 beds, 1.5 bath townhomes. We love that mix. We love washer dryer hookups in the units. If not, can we put them in? But if they comes with them, great. These are some of the things that you're looking for. We love brick. We love pitched roofs. If they've got garages, even better. If they have breezeways, are the breezeways wrapped with vinyl or are they protected? These are some of the things with your buy right criteria. How many units are you looking for? We're looking for anywhere from 20 to 300 units. And this is important because you're going to go to a real estate broker and tell that broker, this is what I'm looking for. Now, it's not to say that if the broker gets a 1970s asset and you're like, I'm not really sure, it just gives you clarity on what you're looking for. You just need to understand it's about the buy right. If you can buy that 1970s asset for a great price and you know the market and you like other factors in the market, like the median income and like the unit mix, maybe that age plays less of a role if you can buy it for a better price. So what I want you to do is focus on your buy right criteria. When you stop listening to me, when this lesson is over, shut it down. Give yourself a few minutes to think about the buy right criteria. It'll give you so much clarity. And when you do speak to a broker, you can say to the broker, hey, Mr. Broker, Mrs. Broker, I'm looking for 1980s and newer, looking anywhere from 20 to 300 units, 2 bedroom, 1.5 bath townhomes. Love them. Hey, if they got brick exterior, even better, washer dryer hookups, I'm looking for median income of at least $50,000. That broker, number one, is going to take you seriously. And number two, he or she's going to start looking for that asset. And it gives you a lot more clarity. And unfortunately, as the market cycles start to change, your criteria is going to start to change. When we started, Jake and I, back in 2011, our buy right criteria was a lot different. In that part of the market cycle, it was a buyer's market. We were buying much older assets because the prices were so low. We were able to fix those and do the BRRRR method, that bigger pockets, buy, renovate, reposition, whatever the heck it is, refinance, roll. Well, we were able to do that in that part of the market cycle because the assets were so cheap. We would refi them and keep them. Some people would just sell them and go to the next one. It's very hard to refinance an asset right now after you repositioned it. You're going to have to hold on. So understanding the buy right criteria really gets affected where you are in the market cycle. Now, this next one is really interesting because all the gurus out there are going to tell you legacy wealth, generational wealth. And I think that's important. But once again, I had said to you before, cash flow gets you out of your job. Equity keeps you out. This next mistake is not having an exit strategy. You hear a lot of investors say, I want to buy and hold for the long term. That may be an exit strategy. Where are you in the market cycle? What kind of assets are you buying? If you're buying a 1960s asset today, that asset is already 65 years old. If you're going to keep it for another 20 years, that asset's pushing 100 years. It's an old asset. Is that the kind of asset that you want to hold long-term? I'm not saying it is or it isn't, but you have to understand that that asset may be great if you can buy it, fix it up, flip it, and get into a higher quality asset with the equity you created. So understanding that you need an exit strategy on every single deal you go into. And your exit strategy may be, hey, I'm going to buy this deal, I'm going to refinance it, and I'm going to hold it. You're crystallizing the equity that way. You're exiting the asset that way. That's great. It's a great exit strategy. We've done that on over 30 deals that we own. We've also bought the deals, refinanced them. Then the exit strategy, the second exit strategy was we've sold the assets. So understanding, eyes open, having multiple exit strategies going in will also help you secure the type of debt. Because if you're going to buy and hold an asset long-term and you're getting short-term debt and you're not going to refi, it's going to be very challenging. Vice versa. If you're going in and you're holding this asset and you're saying to yourself, I'm going to hold this thing short-term, but you're getting long-term fixed rate financing, not a good idea. So understanding what your exit strategy is really important. And this last one really goes hand in hand with what I just talked about, the exit strategy. Most investors, when they start out in multifamily, they don't understand debt. There's two big differences that I see in residential versus multifamily. The first one is multifamily is really not MLS driven. It is a broker driven market. Residential is great. You go online, you go to Zillow, you go to Trulia, you go to Redfin, whatever, all these different sites, it's all pretty much open source. Whereas multifamily, you really need to, in most markets, understand that deals come from brokers. The second component is not understanding debt. In the residential space, you get a 30-year mortgage, 30-year amortization. It fully amortizes equal payments for the next 30 years. In commercial, you can still get a 30-year amortization. But the vast majority of these loans are they're amortizing, but they typically have a term, whether it's 3 years, 5 years, 7 years. A lot of the Fannie Mae agency products have 10 years, some have 12, and very few have 15 years. Now, what happens when you hit that term, one of two things happens. It either balloons, where you've got to pay the entire payment, or it goes off a fixed rate to a floating rate. There's a lot of risk there. So understanding the debt components, then you have short-term bridge, then you have community debt, you have credit unions, you have the agencies, Fannie and Freddie. You need to understand what debt goes with the type of deal that you are buying. If you don't understand that, you are going to make a huge mistake. That's what happened in this last part of the market cycle. Bridge debt is great. It's a great tool to use if you know how to use it. But when you're buying bridge debt, when interest rates have been artificially low for so many years, rates are going to go up sooner or later. And some people accounted for that. They bought what we call rate caps, insurance against those rates going up. But when rates were at 3% and all of a sudden they're up to 8 and 9%, those rate caps got so expensive. And now, remember the exit strategy? Your exit strategy was to flip it out in 2 or 3 years. Well, you can't do that anymore, because all of a sudden debt's gotten too expensive and you can't refinance this property and you can't sell it because it's underwater. So understanding debt is important. That's why, for me, getting a coach, learning all of these different levers, that what I like to call the buy right, the finance right, and the manage right, understanding them completely will mitigate your risk. Now, I love to hear any comments about the mistakes that I've made. And in addition, if you've made any mistakes that I've missed or something that really held you back, please share them in the comments section. Because what I'm trying to do here is I'm really trying to open people's eyes. I really want investors to get into multifamily for the long term. Because if you get into it for the long term, it becomes a business. But it also is better for investors. It's better for other investors, but it's also better for your investors as well. And it's also better for these communities, because they're just not the fix and flip model where you're going in, you're putting a little bit of lipstick on a pig and then flipping it out. That does not serve the community. That does not serve the residents. Holding these assets long-term, continuing to reinvest in these assets and really build the business. Because one of those from last week is understanding that multifamily is a business and you need to operate it as such. That's one that I see all the time. But I've mentioned 5 here for you. I want you down below, just leave a comment. Say, hey, Gino, I've made this mistake. I'd love for you to share. If you liked the lesson, the video, give me a thumbs up, subscribe to the channel. I want to thank you for spending part of your day with me about this important topic. And I know your time is precious. I know you can be doing a lot of other things. And I really honor and I really respect, and it's a privilege to be able to share this information with you to make you become a better multifamily investor. Thanks again, and I will see you on next week's How To. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.